This is forexbrokers.net, and we continued the videos dedicated to the Trading Academy with a new topic, introducing the different types of charts that are to be found on any trading platform, not only on the MetaTrader that you see here. And it is important to know that with the default settings in the MetaTrader, you will have not 3 types of charts, but 4 types of charts. I will explain a bit what the other 4 is. And you can always import or use the custom indicators and import different indicators to alter a bit the chart. Namely, to look at the point and figure chart, to look at Renko charts or Kagi charts, depending on what you're interested in. But the basic types of charts, the ones that are described in the article and the ones that we will show in this video as well, these are the ones used in today's technical analysis, especially the most popular one, the candlesticks chart, the one that you see here. The candlestick chart belongs or comes from Japan, obviously, and these candlesticks that you see here, let me zoom in, represent a period depending on the time frame. In this case, this is the euro and the US dollar daily time frame, and each candlestick represents one day. A candlestick has different elements. It has the opening price, which is the closing price of the previous candlestick, so the opening price, then the closing price. The distance between the opening and closing price is called the real body of the candlestick. Then you have the upper shadow and the lower shadow, if you have a lower shadow. Now, this is the most popular chart for the retail trader. So the chances are that if you start trading or you begin trading on a demo account or whatever, or looking at the chart posted on the internet and so on, the chances are that you will see candlesticks chart. But before the candlesticks chart, before computers, there was a bar chart. A bar chart is similar, and veteran traders still use it to this day, especially on the stock market. It's similar with in the sense that the price action on the next bar, as you can see here, continues from where the previous bar closes, and each bar has a vertical line showing the price action in the period, and then to the left side you have the previous bar's closing price. In this case we have a gap, as you can see. Normally they are aligned, and to the right side you have the closing price of the actual bar, and that would be let's say similar with the candlesticks with a candlestick chart, in the sense that you will still have see the highs and the lows of each bar. But another type of chart, a simpler type of chart, is the line chart. Here if you click, and the line chart looks like this, which is quite a difference when compared with a candlestick chart. Let's have a look at the candlestick chart as well. Look how it is with the candles, with candlesticks, and how the chart looks with the line chart. Now, the line chart considers only a certain price. Typically or usually the default price to be considered is the closing price of the candlestick. The advantage of a line chart is that it filters the noise during the period, during the day, during the hour, during the month, depending on the time frame that you use. For instance, on a line chart, if you take a trend line and connect these highs like this, it tells you that the market, or if you connect these ones like this, it tells you that the market advanced, tries to break, it didn't reach the trend line, and then made a new low. So it keeps you disciplined on the downside, on a bearish trend, which is important on such a bigger time frame, because the market moved from 1.15 all the way to 1.11, and remaining on such a trend for 2 or 3 months is rewarding and generates a lot of pips, and pips means profit. But if you change it from a line chart to a candlesticks chart, you actually see that the trend line was broken. So the mistake here, or the tendency, would be to close the potential short trade, or to get scared and to exit the short trades, to disregard the bearish trend, and to miss this move here. And eventually some traders also go on, reverse the trade, and they move to the upside, go on the long side, because why not, the trend line has been broken. So the main difference between the three charts is that the candlestick chart shows the shadows of the candlesticks, which are important. Price action happened there. The bar chart is less popular than the candlestick chart, and the line chart is a simplistic way of illustrating prices on the currency market or any other market as well. There are some other type of charts. For instance, if you go on the indicators and you go on the custom indicators, there's the Heiken Ashi chart. The Heiken Ashi is nothing but an indicator that changes or modifies the nature of the candlesticks on the chart in such a way that it will disregard moves against the main trend, moves considered simply noise on the period, and nothing else. I will let you handle the Heiken Ashi. On the article that comes with this video, you will also find out more details. But what's important, and the conclusion of this, is that the candlestick chart is the most important one, the most relevant one. It is subject to Japanese candlestick techniques, and extremely rewarding to understand the price action during a period. Thank you for being here, and bye-bye.